Welcome to this special crossover edition of the Consumer Finance Podcast and the Payments Pros Podcast. I'm Chris Willis, the co-leader of Troutman Pepper's Consumer Financial Services regulatory practice. I, along with Josh McBeain, who is one of the hosts of Payments Pros, are teaming up today to bring you this special edition of the podcast that we're posting to both feeds about the CFPB's payday loan rule, now that it's set to become effective again following the Supreme Court's decision in the CFSA case. But before we jump into that topic, let me remind you to visit and subscribe to our blogs, TroutmanPepperFinancialServices.com and ConsumerFinancialServicesLawMonitor.com. And don't forget to check out our other podcasts. We have the FCRA Focus about all things credit reporting, the Crypto Exchange, which is our crypto podcast, and Unauthorized Access, which is our privacy and data security podcast. And look out soon for the launch of our brand new podcast all about the auto finance industry called Moving Metal, which is going to be debuting soon. All those podcasts are available on all popular podcast platforms. And speaking of those platforms, if you like this podcast, let us know. Leave us a review on your podcast platform of choice and let us know how we're doing. And if you enjoy reading our blogs and listening to our podcasts, our handy mobile app is one of the best ways to do it. You can read all of our blogs and listen to all of the podcasts right there in the app, and even access a great directory of all of our financial services lawyers here at Troutman Pepper. It's available for both iOS and Android. Just look for Troutman Pepper in your app store, download it, and give it a try. Now, as I said, Josh and I are teaming up today to talk about the CFPB's newly revived, yet again, payday lending rule, which is set to go into effect soon after the Supreme Court's decision has now come out. Joining us today are our colleagues, Mark Furletti and Jason, who've been following the payday lending rule since its very inception, which seems like a whole lifetime ago. So Jason, Mark, welcome to the podcast today.
Thanks, Chris.
Josh, since you're co-hosting today, why don't I hand it off to you to ask some questions of Jason and Mark about the payday lending rule?
Thank you very much, Chris. I think right out of the gate, Mark and Jason, it's called the payday lending rule, but what does it really cover? Is it really limited to just payday loans?
Yeah, thanks, Josh and Chris. It's pretty interesting. If you go to the Code of Federal Regulations, it says that Part 1041, they call it the Payday Vehicle Title and Certain High-Cost Installment Loans Rule. And then they also call it, alternatively, the Payday Lending Rule. And I guess Jason and I have long thought that calling the rule that is totally misleading. And in fact, what we want to talk about mostly today is how it applies to a much broader scope of products than those that are enumerated in that list that, that's in the Code of Federal Regulations. And so to start, what we're going to do is kind of go through the elements of the definitions of covered loans. And then Jason, I'm going to go through kind of the statutory or the regulatory definition. And then Jason is going to kind of explain how this can cover a much broader product than maybe like your typical payday loan or high cost installment loan. And so the first prong of the definition covers loans that are repayable within 45 days of consummation. And there's no cost analysis here or cost prong. So this is not like, it doesn't have to cost a certain amount of money. It could probably be a no-cost loan or a very low-cost loan, right? This is not a 200% APR concept. It's just if it's closed-end credit and there's not multiple advances, if the loan is required to be repaid within 45 days, then it's subject to this. And if it's an open-end loan and you have to substantially repay in advance within 45 days, you're within the first prong of this. And so, Jason, can you think of any products that are not payday loans or that are not triple-digit, let's say, APR lines of credit that might be swept up by this first prong of the definition?
Yeah, Mark, I think the biggest use case here, and maybe one of the industries that will be very surprised to find out that they are quote unquote payday loans is buy now, pay later. The traditional pay in for payment, no finance charge, buy now, pay later product is typically due within 45 days or less. So, query whether that is now a payday loan covered by this rule. There's also some exceptions for earned wage income and similar products, but they're very detailed. And I fear many of the products out there that are billed as earned wage access or similar could also potentially be caught up in there if their dots and T's aren't crossed.
Okay, so Jason, could you tell us about the extensive research the CFPB did into the buy now, pay later industry in connection with the promulgation of this rule, the payday loan rule?
It was quite extensive in that the research was exclusively done on actual payday loans before really the buy now, pay later industry existed. So 0 is the answer, Mark.
Got it. Okay. That's what I thought. Okay. So the first prong kind of brings in some people who would offer a product that is like no cost to consumer. And so it somewhat kind of blows your mind that that product could be swept in. So moving on, Jason, to the next prong of the definition for hidden traps. So the next prong of the definition is where there's a repayment in a single, where the loan has a term of more than 45 days, but it has to be repaid in either one payment or where there is any payment in the stream of payments due that is twice as large as another payment. Again, no cost. This isn't related to the cost of the loan. It's just any loan. So if you have a loan that has a single payment that's due more than 45 days after consummation, or that you have to repay the loan where any payment under the loan is more than 2 times the size of any other any payment, actually prior or subsequent, you're covered by this prong of the definition. So Jason, what kind of loans here might get swept in that you wouldn't necessarily have expected and that the CFPB, of course, would not have considered and did not, in fact, consider in any way?
So, Mark, there's a number of exceptions in this rule, but banks are not excluded from the rule. So we've found that clients who are, major financial institutions are often surprised that their loans and lines of credit made to high net worth individuals, and there's notably no cap on the amount of the loan. So a loan of $500,000 technically falls under the rule. So many of those products are interest-only payments with a bullet at the end, which would typically be covered by this definition of a payday loan.
Sure. And so I'm concerned, Jason, there's some products out there that have, and a number of them are directed at high net worth individuals that could have these kind of payments streams that are not even. So, I get that a standard auto loan is going to have normally substantially equal payments throughout the term. That's not going to get picked up here. But have you seen any products that might get picked up, whether offered by a bank or somebody else?
Anything that's interest-only payments would typically vary from, payment to make payment as the principal increases or decreases, like on a line of credit to a high net worth individual that many banks would offer. So those are irregular payment streams, and then they're often callable at will or with a bullet. So like a double whammy there in both instances.
Jason, surely before seeking to cover securities-backed lines of credit for high net worth individuals, the CFPB thought about that and kind of articulated why those people need these protections in this rule.
Yes, even, oddly enough, Mark, I don't think they did that study. And at one point, the CFPB had at least somewhat admitted, hey, maybe at least the TILA upper limit for Reg Z disclosures should apply. And they told us they'd get back to us on that. But it's been, many years since that public information was made available. So as of today, there is still no limit on the cap either.
Sure. And just so for those listening, Truth in Lending Act has a cap. It gets inflation adjusted every year. It started at $50,000 a while back. It's probably now closer to 60. I don't know exactly what it is, but it's somewhere in that range. Okay. So Jason, moving on, now we finally get to a prong of the definition that has a cost component. And this is the only one that has the cost component of the kind of 3 kind of major categories of loans that are covered. And so this category sweeps in any loan that has a cost of credit in excess of 36% per annum. And that's measured at the time of consummation for closed-end credit. And then there's a slightly different rule for open-end credit. So, but you have to have 2 things to be true. It's cost of credit in excess of 36%. And the lender has to obtain what's called a leveraged payment mechanism. So Jason, do you want to elaborate on kind of what that's sweeping in, kind of generally, and what kind of products might be there? And I think there's some products even in there that might be a little surprising.
Sure. I guess, to belabor that leverage payment mechanism point, that is essentially any payment mechanism that a lender might get where they pull the funds from a consumer's account. So ACH, debit card, RCC, RCPO. If you can think of it, that it's probably a leverage payment mechanism. And so, to belabor your point again, Mark, the studies were all done on payday loans, not high APR installment loans, not high APR open-end credit. This wasn't something that was sort of thought out, I think, in the context of the rulemaking, or at least not as part of a study. But those would be your two most common use cases, I believe.
So Jason, if there was a product, let's take an open-end product that had a stated APR, open-end APR of, let's say 36% or just under 36%. But then let's just say it had some fees associated with that product. Could that product be subject to this rule, even though
the CFPB has cleverly snuck in a expansive definition for open-end credit that would include various types of fees that might not typically be disclosed as APR on an open-end account opening disclosure. So yes is your answer.
Got it. Okay, so I think that's, so just to kind of conclude this, there are a few exceptions. There's a exception for certain purchase money security interest loans. So that would probably get out a lot of auto-related loans, for example. We're going to soon have another episode on the buy now, pay later interpretive rule that the CFPB put out, in which it says that digital user accounts are credit cards, but they're actually not the kinds of credit cards that are exempt from, in all cases, exempt from the payday rule. Their student loans are out, non-recourse pawn loans are out, and certain wage advance programs are out. So and then no cost advances in certain cases also are out. So in any event, I think the bottom line, the key takeaway is for folks listening who might, be facilitating, they might be fintechs facilitating loans, or they might be lenders making loans. They should probably pull out, 12 CFR Part 1041, look at 1041.3 and see if the loans you are facilitating or making are covered, and confirm that they are or not, because, it is not just something that you need to worry about if you are a, quote, payday lender. So Josh, I'll send it back to you.
Well, thank you both. It sounds like a careful analysis of current products and a parsing of the definitions is important to determine whether this rule covers your products or not. Let's say someone has conducted that work and, concluded that their product may be covered. What does a covered lender need to do to comply with the rule?
Josh, I think in some sense, it may be important to state what isn't required by the law anymore. So this really, to Mark's point, these studies were done nearly at the inception of the CFPB. So this rule really dates, many, many, many years now, over a decade, and was originally issued in the waning days of the Cordray administration in November of 2017. That original rule required ability to repay analysis that was very draconian. And I think by the CFPB's own methodology, they estimated that it would essentially put out of business 60 to 80% of true, regular course payday lenders, not some of the other institutions we're talking about. That rule, the ATR provisions, was rescinded during the Kraninger administration. So, while this has been litigated over the years, that was really a crucial change. And what's left are two primary provisions, the first of which I would call the payment provisions. And that's a blanket rule that says once you're a covered lender under the payday rule, you can't continue with the payment authorization after two consecutive failed payment transfers from the same account. So it's an account-based rule. Once that happens, you have to jump through a bunch of hoops to obtain a new authorization. Otherwise, you have to stop. And then there's a series of notice provisions. There's an initial notice that's sent to tell someone when their first payment is. There's additional notices that are required for what they call unusual payment withdrawals. So that would be a change in amount, a change in date, a change in payment method, or for reinitiated payments. And those can get a little tricky and create a somewhat hectic timeline. And then there's a remaining requirement to adopt policies and procedures. But the real meat here is the payment provisions and the notice provisions.
Well, thank you, Jason. So it sounds like in the first instance, the big challenge is determining if your product is subject to the rule. And once that's been done, you want to comply with the payment provisions. And in doing that, are there any other challenges, presented by the rule when you're trying to comply with those payment provision requirements?
Yeah, Josh, I think, so I have a lot of clients that I talk to and they say, well, gee, Jason, you just summarized this in about 30 seconds. It can't be that complex, right? I stop after two payments and send some notices. And then the more they get into the details of this, it creates a number of challenges, some of which are technical in nature. And just by way of example, I'll use those notice provisions again. If you make a change in the type of payment you're using, and it can even be at the customer's request, like I want to use a different account now, so I change my account. or provide new payment information, my card change, whatever it is, I have to provide a notice. And there's very specific timing requirements on that notice. So there's a window that the payment can occur. And if I don't comply with that window, even if the customer initiates the payment initiates the change, you literally can't make it. So it can be very difficult and lead to unintended consequences. The other issues that you'll find are where I would call them regulatory issues, I guess. There's a lot of open-ended questions in the rule, and some of the drafting isn't that great. So just kind of following through with that same idea of the notice timing, all of it's predicated on a business day, but the rule doesn't define what a business day means. So is that like a business day in the sense of what we all show up to work for Monday through Friday? Is it banking days? Is it the business days the covered lender itself is actually open? No one knows, but you're nevertheless forced to provide these notices on a business day timetable. I know we've written comment letters. I'm sure others have, getting to all of these unknown issues with questions that haven't been answered. And, there hasn't been a lot of movement on the part of the CFPB, whether it's because of the litigation or otherwise, to resolve them. But again, I just, to your initial point of everyone should look and see whether they're subject to the rule. Once you've decided you're subject to the rule, you really need to take a closer look at them because they're quite complex with lots of holes in them.
Well, that's extremely helpful, Jason. How long does everyone have to conduct these exercises of whether they're subject and how to comply?
So the CFPB recently announced the compliance deadline will be March 30th, 2025. So there is, in theory, ample time. But, I would just emphasize again, this is not something where you want to be the proverbial ostrich with its head in the sand. It can be quite tricky and quite difficult once you're in to comply. And I think some of the, whether it's drafting new payment authorizations, adjusting your actual policies and procedures and practices, it's really much more complex, I think, than one might initially anticipate.
Thank you very much, Jason.
Yeah, and Josh, thank you very much for co-hosting this episode with me. And thanks for Jason and Mark's participation to share their very enlightening take on what's going on with the payday lending rule, and particularly the fact that it covers a lot of things that most of us would not think of as payday lending. Thank you also to our audience for tuning in to today's episode. Don't forget to visit and subscribe to our blogs, TroutmanPepperFinancialServices.com and ConsumerFinancialServicesLawMonitor.com. And while you're at it, why not head over to Troutman.com and add yourself to our Consumer Financial Services email list? That way we can send you copies of the alerts and advisories we send out, as well as invitations to the industry-only webinars that we put on from time to time. And as I said at the top of the show, don't forget to check out our handy mobile app. Just search for Troutman Pepper in your app store and you're sure to find it. And stay tuned for a great new episode of this podcast and the Payments Pros podcast on your podcast feed. Thank you all for listening.
Copyright Troutman Pepper Hamilton Sanders, LLP. These recorded materials are designed for educational purposes only. This podcast is not legal advice and does not create an attorney-client relationship. The views and opinions expressed in this podcast are solely those of the individual participants. Troutman Pepper does not make any representations or warranties, express or implied, regarding the contents of this podcast. Information on previous case results does not guarantee a similar future result. Users of this podcast may save and use the podcast only for personal or other non-commercial educational purposes. No other use, including, without limitation, reproduction, retransmission, or editing of this podcast may be made without the prior written permission of Troutman Pepper. If you have any questions, please contact us at troutman.com.